Let's talk a bit more about how Chapters actually structures its acquisitions. We've already mentioned that Mitch Rales is a pretty large investor in the company. So the Danaher comparison kind of forces itself onto the table here. And is there anything in Chapters' approach that feels directly inspired by the Danaher playbook to you?
I think they've copied quite a lot of things, not only from Danaher, but also from Constellation and Transam, and basically the entire reach of these incredibly successful serial acquirer companies. So structurally, most of their deals follow a pretty simple pattern. Chapter usually buys about 80% of the company, and then the founders or the key managers of those companies, they roughly own 20% of that business. And the important thing is that this minority stake is meant to stay in place. So it's not like a typical private equity rollover where everyone knows the company will be sold again in 3 to 5 years, and then the remaining 20% stake will just get cashed out. The default assumption here is that Chapter will own this business forever and it will never be sold. Maybe there's a bell ringing here. It sounds a lot like Buffett and Berkshire Hathaway. So yeah, that's very similar to most other companies that kind of go about the same playbook. But the core business, and I think that's important, it always stays independent, and the people running it remain economically tied to the outcome of those businesses by their 20% stake that they still have. And where Chapters adds a bit of a unique edge, you might say, or a twist, is what happens to the 20% stake, because it doesn't have to stay locked up in the acquired company forever. In a lot of deals, there's an option to convert that stake into Chapter stock later on. So let's say a founder runs the business under the Chapters umbrella for a few years, and at some point he wants to be more diversified or he wants to retire and the cash needs to be more liquid. Well, then he has the option to just swap their illiquid 20% stake in that private company and gets Chapters Group shares instead. So it's more liquid and he has basically equity in that company. And another thing Chapters does that comes straight out of the Constellation and Danaher playbook is the way they use shareholder loans. So when a company is bought or a business is part of the Chapters Group, part of the consideration comes from a shareholder loan given by Chapters to the new onboarded company. And usually there's an interest rate of 10% on that loan. And you might wonder at first why the parent company would give or put such a big burden on a subsidiary, but it actually has some pretty solid advantages. First, it gives companies that are newly acquired flexible funding for acquisitions and investments. And second, it creates a predictable stream of interest income at the holding company level too. And it sends a very clear message that capital is not free, even if it's coming from the parent company. And if you as a manager want to deploy money, what you now have to think about is, how can I make at least a 10% return on that money? Because otherwise, it's just not a profitable thing to do at all. And it also encourages the return of excess cash. So let's say a company doesn't see any opportunities to reinvest the money at returns above that threshold. Well, then it's just better to send the money back to Chapters, to the parent company. So the system naturally funnels capital toward the best opportunity across the group.
It sounds like strict parenting almost in a way, but I mean, I get it. It's less about the literal benefits of charging 10% interest on financing to subsidiaries, but more about kind of the message it sends, as you said. And ideally, you'd have such great people in place who understand capital allocation well enough to recognize when to funnel profits toward the top of the holding company if their subsidiary can't find sufficiently attractive reinvestments. But I do think that this is a pretty pragmatic way of enforcing that discipline. And so just shift gears here a little bit and take a closer look at the numbers. What kind of financial profile are we dealing with here? And how should investors think about the earnings power of Chapters going forward?
Well, there are definitely easier tasks than trying to dig into the financials of a young and decentralized holding company. I mean, the problem that you generally face is that things are just moving very fast. The reported numbers are quickly outdated. If you open the annual report and just look at the headline earnings, you would honestly think this is some money-losing early stage roll-up experiment. So you really have to look at the operational business level and the actual portfolio companies. And this is, once again, we talked about it with TransTime, why we look at EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And the reason why EBITDA is so important for M&A heavy companies is that it strips out depreciation and especially amortizations from acquisitions. So when you buy companies, you create these big accounting amortization charges for things like customer relationships, software, and goodwill. And those charges don't reflect the current operating performance of the acquired company. So EBITDA removes that noise and just makes it easier to compare subsidiaries and really track the real underlying profitability of the group. And if you take the business they owned in 2024 at year end and you pretend they had been part of the group for the entire year, they would have generated about 125 million euros in revenue and a little over 30 million euros in adjusted operating EBITDA. And that's a margin north of 24%. And if you listen to the company, they think this margin could, over the long haul, go to the mid 30s. And already in the first half of 2025, the same portfolio produced 85 million euros of revenue and almost 20 million euros of EBITDA, which annualizes to a business that's getting close to 170 million euros in revenue with high 30s in EBITDA. Annualizing these is always a bit difficult because deal flow could be slower in one year than in the other year. And also these smaller companies tend to be a bit more volatile. But still, these are the numbers you get and you have to work with them. And Chapters is definitely in the very early stages. I mean, at the end of 2024, Chapters had roughly 260 million euros invested in majority-owned holdings. That was 140 million euros the year before. And in 2025, if you include the first half, the number is now north of 540 million euros. I know those are a lot of numbers, but this is just a huge increase. If you add in the structuring for financial technology clusters, so the business has scaled massively. So that loops back to our dilution discussion. Dilution is obviously uncomfortable, but at this stage of the company, when you're compounding at this pace and you're deploying hundreds of millions into what really are high margin, mission critical businesses, this is the window where it actually makes sense to do that. So EPS, obviously, if you look at this graph, gets pressured in the short term, sure. But if the fundamentals keep developing like this and the earnings power just catches up, raising equity today can still be the value maximizing move, honestly. And according to the CFO, like I said, the business would have been self-sustaining roughly 2 years ago. So any new capital that is coming in, whether it's through equity or debt, is really just about accelerating the pace of growth rather than funding basic operations.
It's tough for us to underwrite the earnings of this business when it's just based on acquisitions and we don't know when they will happen. And so to some extent, for us to even really consider investing here, you just have to believe that this will work out. And inherently it's a speculative bet that does require a degree of optimism. But then again, though, the thing that reassures me is that you're riding in the sidecar, right? Sidecar investing alongside these very successful and highly experienced investors who are well aligned with shareholders in Chapter. So that is honestly, I think, the main angle here. And when you look at the fact that leadership, they literally paid premiums when new equity was issued, I just don't think we would be in bad company, literally, to be partnered alongside them. But before we move into the valuation, we should still talk about the risks. And I think there are probably plenty we could name for a company at this stage.
Definitely. If I'm being honest, I find it very hard to pinpoint specific risks at this stage of the company. Yeah, I could give you a whole list from growing too fast and onboarding companies that just do not have enough quality just for the sake of growing the company or the top line, to overestimating pricing power and just organic growth. I mean, you could even argue this to some extent already happened. The full year guide for revenue this year was revised down from mid-teens to single digits. EBITDA is still supposed to reach mid-teens growth though, so I don't know. To me, this seems like no big deal, but it does show you how volatile these underlying businesses still are, and it's just very hard to judge what the actual earnings power is.
The thing is, if a large and established company were to cut their revenue guide from mid-teens to mid to high single digits, I mean, it would be a massive drawdown in the stock. We've seen that with some of the stocks we've looked at before. But as you said, these smaller companies are just much more volatile. And so there's a reason Jan Moore emphasizes the long-term view so often and riding through the waves that are kind of inevitable in this type of young business.
You kind of talked about it, but ultimately, I think this is a case of trusting management and the people who are involved in the company, even though they're just shareholders, for example. I mean, a while ago, I read the paper by Richard Zeckhauser, who's a Harvard professor, and it was about winning the investment game, considering how many things are unknown and in fact actually simply unknowable. And one of the strategies he outlined was what you just mentioned, sidecar investing. So those are investments where you are riding along in a sidecar pulled by a powerful motorcycle. I mean, Berkshire Hathaway, maybe one of the most prominent examples of that, was such an investment, and Buffett was basically the engine of that. And you could make the same argument for Mitch Rales. And I might sound crazy when I say this, but I wonder whether Chapters Group could be such a sidecar investment as well, bringing together the best of the best to help this company succeed. It's kind of funny that I come back to this because honestly, when I started my research, the thing that got me excited about this company the most was the shareholder structure. Then I started digging in and expected that I would see something else to come up and then become the number one reason to get excited about this opportunity. But to some extent, I looked for what all of these great investors see in Chapters Group. And while I liked everything I saw regarding the operating businesses, the acquisition strategy of the company and all of that, I did realize in the end, I would still make an investment decision based on the shareholder structure. Over the time that I've looked at this company, it just hasn't clicked to the extent where I could say, okay, well, now I understand what this serial acquirer should be so much better than all the others out there.
If I've learned anything about serial acquirers, and I've looked at them, a lot of them over the years, from studying Buffett to just my time at TIP. I mentioned Technion earlier. And so I just think it's really about what matters most is the people at the top and the culture from top to bottom, to be a little cliche. And since you're in Hamburg, maybe you can actually connect with some folks who work with the group to get a feel for that culture. But from the top down, it seems like an incredible cast of people running things or involved behind the scenes, or at least participants in the equity of the business. And so clearly that is really the driving part of the thesis, for better or worse. If people want to criticize us for ending up investing in it, they would say that we're just kind of willingly betting on this management team. And I think that's probably not a mischaracterization of things, right? It almost sounds bad, but I'm sort of indifferent to what types of acquisitions they're specifically doing and the niches that they're targeting, in the sense that I trust these to be very smart people who know more than me with proven track records. So if these are opportunities that they are tackling with Chapters and it makes sense to them, then I'm just happy to trust that as a true sidecar investor. That's really the whole premise behind it. So this is not a situation where I feel equipped specifically to analyze and comment on the areas that they're making these acquisitions in. I don't really know a lot about international students and the education process in Germany. And it is just very niche. And so the question is really whether these are people ultimately that you want to invest alongside for a company that is ultimately an acquirer with no core underlying business in itself, which can make it very dynamic and agile, but also at the same time, you're not really discounting the current earnings of the business in the way that you normally would. You're really discounting the value of the capital allocation decisions that will be made in the coming decades by the people at the top. So a lot of the same people are kind of doing a similar calculus when they think about Berkshire Hathaway at a much similar scale, where they're thinking, hey, I was happy to own shares while Buffett and Munger were the ones calling the shots and had this incredible track record of making very accretive capital allocation decisions. But now the question is, do I still feel good about owning the stock with others making the capital allocation decisions? And maybe I'm going to demand more of a discount to the current price or the current book value or earnings multiple, whatever it is, to feel comfortable that you are making an investment that has as attractive of a risk return profile as you would normally make and had been making for years with Buffett and Munger at the helm.